Well, Dinanath Dubhashi, Managing Director and CEO of L&T Finance Holdings joins us now. Mr. Dubhashi, good morning. Thank you for joining us. So, well, it's been a tough patch for all of us, both personally and professionally, but you've managed to grow. 20% year-on-year growth. Let's talk about what has led to this growth.
Last time, I would take it to last time I spoke with your channel. And that was at the end of the Q4 results. And we had mentioned at that time that there are a few things that the company is doing. That is going beyond the profits and quarterly performance. That is to make sure that we build strengths, which will help us to do well in the medium to long term, but also deal with any short-term problems which come. And the short-term problems came immediately almost after our annual results, right? So the strengths we had built up was a strong balance sheet with good provisioning. We had just raised a rights issue. We had built business strengths. We have built collection strengths. We have built strengths on the liability side. And each one of this was tested in quarter one. Quarter one was very strange. First 15 days of April were absolutely okay. The second 15 days of April, entire May, and maybe the first 15-20 days of June were very bad. And very bad in the sense, I mean, forget business and all. People were afraid of their lives, and we all know that, right? And then again, things have started improving towards the end of June, and July, they have improved even further. So the strengths that we have built, how they are manifested, as you rightly put, profits up 20%. Now, I must also say that we are comparing against last year first quarter, which was also a bad quarter. So I must be upfront about that. But still, a COVID quarter to COVID quarter, 20% growth is, I would think, a good performance. There are some things which have happened even better. Is we, even in this climate, we have done in our rural book, our best ever first quarter disbursements. When, you know, for a month and a half, everything was closed, but best ever first quarter disbursement. Our rural book is actually up by 8%. We have seen some rundown and some prepayments in our infra book, which has actually taken our retailization quickly up to around 46%. So these are the good things. Second is cost of liabilities. The liability franchise we have built, cost of liabilities have remained very well in control. In fact, remained at the same level as it was in Q4 and substantially below last year Q1. So all this have led to a good growth at the before provision stage, which has enabled us to take further anticipatory provisions, or what we call macroprudential provisions, and make our balance sheet stronger. So last year what we did, we built macroprudential provision in first 2 quarters, and the last 2 quarters we reversed them, and which actually helped us. This method of taking early provisions and then using them helped us. We are doing that again. We have taken around 370 crores. But God forbid, if a COVID wave 3 comes, and I don't think anybody can predict that, we will be ready. And that kind of balance is what actually signifies and is the importance of this quarter's result. Of course, the icing on the cake is the 20% profit growth.
But if that is the case, then why is that your NPAs for the quarter gone by, they've gone up by nearly 75 bips. Also, if one looks at the provisioning cover has changed.
Most definitely, COVID quarter, the gross NPA is going up. No surprise. I mean, it is a COVID quarter, right? So that's one thing. But if you observe carefully, actually, if you compare year on year, the absolute amount of gross GS3 has actually come down. It is basically because the book has gone down, as I told you, because of the infra prepayment, that the ratio has gone. Okay, so just to point that out. So the overall gross stage 3 absolute amount has actually little bit come down, or let us say remain the same year on year. So that's the first thing I would like to point out. But it is no surprise, and I would like to defend that gross stage 3 will go up in a COVID year or in a COVID quarter, and hence what we need to do. And you never know, that trend may continue. We are hoping that it will reverse, but it may continue. And because of that, what is important is we create additional provisions. Now, provision coverage on NPA is a function of a ECL model. So it can go 3-4% up and down. So that is one thing. But if you count our, 1,400 crores of additional provisions, which is there now on the balance sheet on standard assets, right? That prepares us tremendously for any NPA increase which may happen. And that's the point that I'm trying to make, rather than a quarter-on-quarter change in NPA. In any COVID wave, and especially the wave that was there, the second wave, where customers were afraid. Frankly, our people were afraid of going out for a month or so. There were restrictions on movement. So most definitely it will affect. The point important is that we have made provisions, anticipatory provisions, and are ready to face any further effect of this that may happen. The positive side is I think businesses are picking up. Rural India is definitely picking up. And most importantly, our people are now more than 90% vaccinated. We did a big campaign, and more than 20,000 of people now are vaccinated, and hence more able to travel. So I think the medium-term prospects look good.
Right. Sir, given the COVID second wave is receding, can we say that worst of the impact as far as collections or asset quality with respect to the second wave is over? Of course, there is a risk of third wave, which cannot be denied, but is the second wave impact largely behind?
Sure. So I will talk both business as well as collections. So business farm, that is tractors, have started recovering very quickly. In fact, as the rural India opened up. See, the important thing is manufacturers faced supply chain problems last year in the first quarter. This year, there were no supply chain problems. There were, the manufacturer, the production was happening. So the question was whether point of sales are open, whether tractor dealerships are open, two-wheeler dealerships are open. The rural dealerships opened earlier, and that the business started faster. The urban dealerships are just opening, and we hope that the business will start from there. If you talk about microloans, as collection picks up, then disbursement will also pick up there as we go ahead. Housing, definitely, again, lots of registration offices were closed. People were unable to visit sites to go and buy a house. Buyer and seller meetings were a problem. So all this kept quarter one at a fairly low level. Slowly, these things are picking up. But the important thing is collections. Collections, actually, the collection efficiencies, which we have shown and we are put in the presentation, have actually, other than microloans, it has improved between May and June, all the other products, and that is important. And microloans didn't improve in June, but already in the first 15 days of July, it has improved, and it has improved substantially. So I wouldn't be crystal ball gazing and say the worst is over. I think this can be the famous last words going by our COVID-2 experience. But most definitely, July is looking, in most products, actually June looked better than May, and July is certainly looking better. Now, yes, if a COVID wave 3 comes, who knows? I mean, nobody was able to predict a wave 2, so I don't think anybody will be able to predict wave 3, and hence we should be prepared in all the aspects of the company. But to answer your question in one short sentence, July is definitely looking better than June.
Sir, in Q1, L&T achieved a NIM+Fees of 7.52%. What is your outlook for margins in FY22, given the kind of uncertain environment, given that maybe interest rates have bottomed out in the near term?
Yeah, so margins is a question of two things. One is interest cost, and I said that our treasury has done extremely well to keep the interest cost well in control. And Q4 we thought was the lowest ever. In Q1, we have done at the same level. I mean, we have reduced it maybe by 1 basis point, but that would be very good. The second good thing we have done is actually using this low interest cost regime have locked into good medium to long term funds. And hence we believe that even if the cost of funds will definitely slowly go up from Q2 onwards, but the trajectory will be lower and hence we will be able to retain our margin. The second part which works on the margin is the mix between retail and wholesale. And as we said, this time our infra business and infra book actually degrew. Infra book degrew and the rural book grew. And because of that, the product mix moved towards higher margin products. So it is that. So to answer your question, 7.5 is definitely way above what we guide. But yeah, I don't think it should fall way below 7% or anything like that. We always guide between 6.5% to 7%. We should be able to stay on the higher end of that guidance throughout the year.
Mr. Dubhashi, in the Q1 update, most lenders have reported a slowdown in growth. So I have a two-part question. Has demand been impacted or are lenders being a little bit cautious towards lending? And what is the kind of loan growth that you're anticipating for FY22?
Okay, it is actually on the contrary. Our loan book has fallen mainly because of prepayments in our infra book, which is good for the quality of the book. But what it means, why does prepayment happen? Prepayment happen because other lenders are ready to lend at much lower rate. And actually that shows that demand and the hunger for business is actually much higher amongst other players. And we have actually lost our book in infra, and that is the need for the reason for the loan book drop. As I said, rural, we actually did our highest ever first quarter business in Q1, which makes us, pretty hopeful of a better Q2 as we go ahead. The precise growth rate, I don't think in the current environment, I will even dare to do that. I mean, imagine if I would have given you a number for Q1, I would have looked like a fool, right? So in the current environment, it will not be proper to give that. But more importantly, I will say something that given the other parameters like profitability, like asset quality, right? Keeping good provisions and helps making the balance sheet strong. I will rate all these things much above loan growth. So I will make sure in this climate that profitability, asset quality, provision regime, strength of balance sheet always gets higher ranking in our strategic thinking than loan growth. Loan growth will happen. This is not the time. Pitch is swinging. At that point of time, staying on the pitch is important.
And given that the RBI and the government have taken several steps to support the bottom of the pyramid, rural recovery, the MFI segment, do you see the need for more such measures, and how have you viewed what has been done so far?
I think more and more is always welcome. There is no question about it. But already the steps taken in terms of making more funds available, allowing a one-time restructuring for those accounts, etc., are already working. And I would believe that bottom of the pyramid, even one level above that, situation is improving reasonably well. It will take some time, no doubt, but it is improving reasonably well. So, we should never keep, we should, of course, expect more from the government, but not make an excuse of that. I think government has already done reasonably good things, and it is up to us to make sure that those measures reach the people that they are meant for, and do good business in the process.
Thanks so much, Mr. Dubhashi, for joining in and walking us through your numbers. Time for a very quick break. Be right back. We've got lots more lined up when we return.